Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. So despite the biggest bank failure since 2008, an ongoing banking crisis, signs of contagion around the world, it seems stocks are rallying. Short-term momentum is curling up here. It looks like we might get a breakout of this downtrend line resistance here. And the big reasoning behind this is that the banking crisis is behind us. They're once again expanding their balance sheet, providing liquidity to the financial system. And they've even talked about ending rate hikes now, which is exactly what brought down the markets throughout 2022. It's been the tightening of monetary policy that began here at the beginning of 2022 that brought the S&P 500 down into a bear market. So in this video, I'm going to show you why the banking crisis has not yet been priced in by the market, why it's not really behind us, why the repercussions that this is going to have on the economy has not been taken into account by the financial markets. I hope you guys are going to enjoy this video. If you do, don't forget to smash the like button and of course subscribe to the channel if you are new here. Now without further ado, let's get right into it. Now, what's driving this move higher in stocks? Well, let's look at short-term rates, the 2-year yield, which is what the market expects the Fed to do in the next 2 years. There's other variables that go into this, but it's mainly market expectations of the Fed's monetary policy. And you can see following the banking crisis, that collapsed right here. Massive drop on the 2-year yield. And yes, initially stocks went down and they seem to be recovering. So again, higher rates is what drove the market down throughout 2022. So some investors right now are saying they're going to be cutting rates later this year. That's what the market is pricing in right now. And yet you look at the unemployment rate and it's not showing any signs that we are really in a recession. The labor market is still very, very strong. Now, this is exactly what happened in December 2018. The Fed paused monetary policy here, even though we were not in a recession. The labor market was strong. In July 2006, the Federal Reserve stopped its hiking cycle. We were not yet in a recession. The labor market was strong. The same thing goes for 1995 right here. The Fed pivots, but we're not in a recession. The unemployment market is strong. And again, in March of 1989, the Fed pivots and we're not yet in a recession. The recession only really hits in June of 1990. Now you can see in all of these examples, the markets rallied and took out their all-time high. In all of these examples, the Fed pivoted. We were not in a recession, and so the markets rallied to the all-time high. Again, in 2006, rallying to the all-time high. And 2019 eventually rallying to the all-time high. So there is a pretty strong case right now to be made for why stocks need to rally. There's a lot of very smart people right now saying that this rally can last a lot longer, that stocks can go a lot higher. So make sure to take whatever I'm about to tell you with a grain of salt, because this is my opinion that's based on the research that we do at gameoftrades.net. It's all backed up by quantitative work on the macro environment based on historical data that increases the odds that we are right, but it doesn't guarantee anything. So let me show you why the market is being way too optimistic right now. Domestic bank lending standards have been tightening throughout 2022 and 2023. This is the last data point that we got. Notice that this is a data point from February 6th, so before the SVB collapse. If you saw the last video, you'll know that the SVB collapse only increases the odds that we see further tightening of lending standards. So why am I showing you this chart? Because if I add credit spreads, that red line right here, that's credit spreads, you can see how strongly correlated they are to the tightening standards of commercial banks. Every time you see a move up in tightening, you see credit spreads rise. Now, credit spreads are the market's way of pricing in default risk. You can see how high these were in 2008. When you had the financial crisis, you obviously had very elevated probability of defaulting in that environment. It cleared out a huge number of very bad companies, and so the market was pricing that in. Now you can see the massive divergence that we have right now, and this is something that we really haven't seen to this extent throughout history. We have commercial banks tightening their lending standards massively this year to comparable levels to 2007 and to 2001, both triggering recessions. But financial markets here are not pricing that in. Remember, this blue line right here, this is just a survey that the Federal Reserve conducts where they basically ask domestic banks, how easily they're giving out loans to large and middle market firms. The red line here is actually financial market pricing. And so this divergence that we're seeing right now is basically telling us, well, the market is not pricing in what's actually going on in the banking system. Banks are not making loans easily. Now, this correlation that we have makes perfect sense, right? When banks tighten their lending standards, credit is less available, so companies have more difficulty to refinance. And so when these companies are experiencing losses, if banks are not willing to loan them money, the probability of that company defaulting is much higher. Now let's take a look at those 4 examples that we talked about at the beginning of the video. These 4 examples where the Fed pivoted and you had stocks rally significantly as a result. December 2018, you can see right here, lending standards were easy. The zero line right here, when the survey is below the zero line, it means banks are easing. When it's above the zero line, it means they're tightening money, they're not giving out loans. In December 2018, money was easy, and so you didn't have a reason to really be concerned about rising default rates in that environment. And so that's why following the pivot, credit spreads went back down and the markets were able to rally for a very long period of time in 2019. Now in July 2006, that's around right here, again, you can see even though that was before the global financial crisis, why did the markets rally so much? After that pivot, you can see here markets rallying for multiple months leading up to the all-time high that was of course eventually followed by the financial crisis. But this type of move is very dangerous to anybody who's bearish on stocks. Why did that happen? Because lending standards at the time were easy. Banks were giving out loans, and so the economy was able to grow and credit spreads had no reason to rise at that moment. Now let's look at the last example that I gave you, which is March of 1995. You can see where lending standards were again very easy, no problem, no reason to be concerned about a credit crunch in 1995. Now, unfortunately, that last example of March 1989, where the markets did rally significantly following that pivot before, again, eventually the 1990 recession followed. Unfortunately, we don't have data going back to March 1989. So we'll have to put a question mark right there on that data point. But based on the information that we have at hand, we have a massive divergence that we've never seen in the last 30 years. It looks like the divergence that we had in 2007, where you did start to see tightening lending standards right here and credit spreads were falling. You can argue that's a similar setup to what we have today. So what does this all actually mean for the market? Well, financial markets have a lot of catching up to do when it comes to pricing in the reality of the tightening that we've had over the past year. Before we actually take a look at what it means for the market, let me give you the scenario where credit spreads don't catch up. In order for that to happen, you need to see the Fed pivot. You need to see the unemployment market remain strong. So that means not going into a recession and seeing the unemployment rate rise, which has never happened when lending standards were this tight. Systematically, it creates a recession, and you need to see inflation come back down to 2% despite the fact that the Fed is cutting rates and despite the fact that we are not heading into a recession. That's the only way that you could actually see tightening standards fall without credit spreads ever pricing in what happened here. And that actually did kind of happen during COVID here, where in Q3 of 2020, you had banks that were very concerned about the financial system, but the market was pricing in the fact that the Fed was pivoting, injecting a lot of money in the system, and that these lending standards would ease again, and the market ended up being right about that. But of course, that is the furthest away from our base case scenario right now. We expect a recession. We expect that unemployment is going to rise this year. And if by some miracle that does happen and we don't get a recession, well, in that case, inflation is not going to be coming back down to 2%, and the Fed is going to need to keep on tightening monetary policy. So again, what does this all mean for the actual stock market? Let's take a look at what happens to the S&P 500 when these credit spreads rise, if we do see a catch up to the upside. Now, reasonably, when you look at this indicator, you should expect credit spreads to rise around to 12% here, or at the very least 10%, just like we had in 2002 right here. So let me show you this chart right here of credit spreads and add the volatility index of the S&P 500 on top of this chart. And you can see again the tight correlation that we have between the VIX and credit spreads. So if we believe that the market is going to start pricing in those tighter lending standards, that's going to translate into higher S&P 500 volatility. And just eyeballing this chart, you can see if credit spreads reach 10, you can generally expect the VIX to reach around 37. Now, if the VIX rises to 37, guess what happens to the stock market in that type of move? You see it move down substantially. Every time volatility spikes, the market moves down. That's how it works. And when it reaches around 35, that's at least a 10-15% drop. Now, we're not yet shorting stocks at gameoftrades.net, but that's definitely on the table if we believe there's an opportunity to do that. Since February of 2022, we've been positioned for the recessionary trade, for rising volatility. We even booked profits on our portfolio when the VIX spiked to around 30 during the banking crisis. This is really what the service is all about. It's to help individual investors navigate all types of macro environments to try and consistently beat the market, protect your portfolio from downside risk, and maximize any potential reward. We give notification updates whenever we make any changes to the portfolio, and we give lots of forward guidance and explanation and education around the decisions that we make on the model portfolio to be completely transparent with you guys. Get your free trial, join the community. You won't regret it. Now, that's about all I wanted to cover in this video. I hope you guys enjoyed. If you did, make sure to leave a like down below and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.